Today's guest has found a way to combine the best parts of debt and equity investing. His hybrid loan model allows him to lock in first position liens and also gets to participate in the upside of these deals that he participates in. So today we're going to be talking about how he structures those deals, how he finds the right operators, and questions you should be asking if you're looking for those safe debt deals. And if this is your first time on the show, make sure you hit that subscribe button so you get more content just like this. Hey, Dave, thanks for being here and on the show. And I really just want to start off by letting you introduce yourself
Yeah.
and telling our listeners what you do right now.
Yeah. First of all, thanks for having me. It's great to be here. And yeah, I'm originally from Utah, came down to Arizona State University back in 2003. Went to ASU about my junior year. I was looking around for a job. That was the normal path. And what ended up happening was I stumbled onto this ad that said buying and selling commercial real estate loans from banks. And I thought, what the heck is
Okay.
that? So I ended up answering the ad. It was a really wealthy guy who was buying commercial real estate loans from banks. Did that for a couple of years. It was fantastic experience. And that
Okay.
really ended up launching me into the commercial real estate world, which I've been in for about 21 years now,
All right.
doing
Good. That's a
commercial
good
real
track
estate
record.
financing. And so I've been through all the ups and the downs. June of 2008, all the wonderful
Mm,
things happened through that time frame as well. I've underwritten about 500 loans. I've done about 1.1 billion myself, and collectively probably about 2.1 billion. Was a rugby player for 5 years. We won 4 out of 5 championships. Eagle
oh man,
Scout,
awesome.
all there at our church. So, yeah, just a little bit about me.
Okay, awesome. That's good. That's going to lay the groundwork for how you got to where you are. So, um, hybrid debt fund. Give me the 30,000 foot overview of what that means,
Mhm.
and we'll dive into all the details of exactly what those look like. But what is a hybrid debt fund?
Yeah, let me just start off by saying we saw like a gap. There was an issue in the
Hmm.
market where you have your traditional situation. Person comes in, they have a development. What do? They go get their bank debt or private debt, and then they go raise their money. It's pretty normal, and that has all sorts of challenges that comes with it. And so we just saw this huge opportunity, and it really came through me representing a life insurance company that has a product called a participating loan. And what that means is they take a first deed of trust. They do what's considered a stretch senior loan. So they go all the way up the stack up to 85, 90% of the total
Okay.
cost.
Yep.
And so if somebody has, 5, 10, 15% already into it, they don't have to go raise equity outside of their own kitty. And what happens then is you provide about a 3-year note, and it could go a little longer. But ultimately, what happens is you've got just like a bank loan, draws, everything else you would see. The difference is you don't have to come in with as much equity. And then us as the lender, we take a participation on the upside of about 30 to 35%. What that means is we
Okay.
take 30 to 35% of the cash flow, and then we take
Okay.
30 to 35% of the reversion. And
Okay.
so that means once you sell in 3 years, pay off the loan, pay the fees, and we split 65-35 or 70-30. So that's the general impetus of the program itself,
Okay.
if that makes
Okay.
sense.
No, yes, that does make sense. So, um, you gave us the brief overview, but tell me a little bit about that 21 years in commercial
Sure.
banking,
Yeah.
essentially,
Yeah.
that led you to where you are with the hybrid debt fund, and then maybe when that got started.
So again, June of '03, dove in, started originating loans, started our own firm called Integrity Capital.
Okay.
And so we were representing developers all across the country, doing multifamily, retail, industrial, self-storage, hotel, you name it. We've
And so that was
funded
like
it.
traditional mortgage
Mhm.
brokering. I say
Correct.
mortgage, but
Yep. Yep.
commercial loan brokerage.
Yep. It is. Yeah, it
Okay.
was all debt equity advisory. So raising equity, raising debt through
Okay.
banks, life companies, CMBS,
Okay.
all across the board. So just had tremendous experience and understanding, seeing deals, underwriting, going through ups and downs markets, really understanding the intricacies of what really matters, what makes something work, what doesn't. And, just through that experience, I thought, man, there's got to be a better way. There's got to be a different, this is so archaic. I mean, if you look at the
Mhm.
commercial real estate lending industry, it's very antiquated. It's
Mhm.
just, it's the same way, the same industries, the same process. There just hasn't been much change.
Yep.
And so when I stumbled onto the participating loan, I just like to think outside the box. So I thought, man, this is great because you get the benefit of the deed of trust. You get the benefit of ultimately having a loan. You get the opportunity for upside, plus you get the
Mhm.
ongoing income and you get a guarantee. So as long as you've done your underwriting well and you're dealing with the right sponsor who really knows their craft and has the financial liquidity,
Mhm.
then it could be a great situation. And furthermore than that, what it also means is that that sponsor doesn't have a partner. We're not in their LP. We are
Yeah.
just a lender that gets additional interest and upside participation. So
Okay.
they get to keep the depreciation, they get to make their decisions. We get to protect our downside. We have a first right of refusal. So if they decide to dump the asset, we can step in if we don't like the price.
Okay. Yep.
But so it just creates a really good win-win situation. But through that 21 years, I just learned a lot of different things. I've dealt with a lot of different people. 10 plus thousand hours for sure and more.
Yeah.
Just to, we've had our wounds. Every one of my gray hairs has a story.
Yeah.
So you just, when you have that under your belt, you can walk in with a different pair of eyes.
Yeah.
Um,
So when did you make that transition from that traditional mortgage
yeah,
brokerage to, you actually being the guy that's making those participating loans?
yeah. About 2.5 years ago, we were at a retreat and we just said, I think if we're going to really add the value we want to, then we
Mm.
need to set up our own fund. So that began
Yep.
the journey of setting up the product itself, testing it for about 6 months to see if the market even wanted it or liked it, both on both
Yep.
the investor side and both on the lending side too. So we just wanted to make sure it would be received. And so about that time was when we started making the transition to more of a direct private credit commercial real estate fund. And yeah, we're
Okay.
currently raising, deploying right now, and we'll be doing that for the next 12 months or so. But so yeah, it's been a great journey, a lot of work, and there's a lot more to come, but definitely worth it. And I think we're going to do some pretty cool things going forward.
Okay. All right. So there's which is kind of an interesting dynamic here that I want to dive into because on on one side of the coin, you are stepping in with a GP or a syndicator in
Hmm.
place of them raising from you know 20, 40, 50 LPs, right? So our listeners
Yep.
are LPs, and so it's like, oh man, you just took the position that they might otherwise be looking at. Um, and there's reasons for that. I want to dive into everything
Yeah.
from sponsor down,
Oh yeah.
but and so it's just a different offering at that point,
It's a very
right? So
different
you're
offering.
taking the position of participating in the upside, also potentially the downside, and then you have LPs that are working with you,
Correct.
and so the hybrid debt fund, and we'll get into like specifics in a minute, but that
Yeah.
just cash flow? Is it some upside? What does that typically
Yeah.
look like?
Yeah. Let me kind of walk you through it. So first of all, it's a strategy that's been around for 40 years. So this isn't like a,
Okay, that's
new
always good to
thing.
hear.
Yeah. So this isn't something that I just sort of, came up with my garage. This has been around for 40 plus years. There's two major life companies that deploy this. And
Hmm.
so that's the good news, right?
Yep.
This isn't, there's nothing new under the sun per se. It's just a very nichey component. And so you've got this commercial real estate blend of like private equity that includes the consistency of income,
Hmm.
blended with that upside participation. So the investor, again, they go into a pool. That pool then has the first deed of trust that gives the security and the strength, right, to
Yep.
control the asset and then minimizes the risk. And then the asset types are, again, apartment, industrial, retail, storage are kind of the four food groups that we're really focused on
Yep.
right now and just growing areas. And then what happens is when that investor comes in, they get a current pref of about 5.5%. So
Yep.
current income paid out quarterly, and then so it's providing this ongoing, stable, secure income that comes from the extraction of the construction deployment of interest reserve. So money's just already baked into the deal.
Okay.
And then what ends up happening is when we get to, well, and one more thing too, we get a payback guarantee. So anytime in construction, we get a payback guarantee until they hit break even interest only debt service, which takes a while and they may never get there, at least in the time that we do with them.
Okay.
But what happens is when you get to that place, so let's say a apartment complex gets to the place where they actually um, turn the corner and they're actually making income,
Sure.
then we get from the net cash flow after they paid the debt, we split 65/35. So quarterly,
Okay.
then we're going to start getting that income as well that gets deployed back to the investors in a pro rata share based on the waterfall, which I'll talk about later.
Yep.
And then the final component is that reversion moment. You say, well, what's that? Well, in 3 years, we will have expected that they're either sold or selling the project,
Hmm.
or they're just going to take us out. And I'll walk through
Permanent
both those scenarios.
refinancing,
Permanent
or I say
refinance.
permanent might not, permanent might not be permanent in commercial space, but yeah,
Correct. Yeah,
longer
exactly.
term.
Longer
Okay.
term. So
Okay.
what
Yeah. And I
happens?
think, yeah, go ahead.
No, go ahead.
Well, and as one thing I wanted to just to maybe have you explain a little bit was,
Hmm.
and you mentioned it on break even debt service. They're
Yep.
on the interest, I think is specifically right.
Yes.
So one
Correct.
big difference, and a lot of our listeners might be newer to the alternative asset space or the commercial space even.
Yeah.
So if they're used to maybe seeing single family homes, and in their head, break even means PITI, principal, interest,
Sure.
taxes, and
Yeah.
insurance,
That's
which
right.
is a pretty big chunk when you look at rents and carrying costs and everything like that on single family.
Yep.
That's not how we're talking about commercial, right?
No.
That would be like rental. That would be like the cash flow just having to cover the interest on the mortgage. And that's what you're talking about, correct?
Yeah. So think about apartment complex. You get your rents in, you deduct all of the operating expenses,
Hmm.
taxes, insurance, everything that goes into it, getting to what we would consider net cash flow or net income.
Yep.
And then that is what is going to be available to pay the debt service. And in
Yep.
this particular case, it's what would be calculated, not just principal interest, but it'd be just the interest only,
Yeah.
right?
Which
So
is significantly more common in the commercial space, interest only
that's
loans.
correct. That's
Yeah.
correct. Yeah.
Okay.
Especially during quote unquote construction or lease up. You're
Yes.
more than likely going to have interest only, even on perm. CMBS does it all the time. Life companies do it quite a bit. They'll do interest only for 5 years or so. So what happens is then that we need to see it a 1-to-1 break even to basically not even burn the whole guarantee off, but get it down to 50%. So we'll
Hmm.
go down to half guarantee at that point. Then when they hit 1.25 on a PITI at the stabilization, assuming we're still with them, then they would burn off
Okay.
completely. Chances are they'll probably be out of that. Um,
Okay.
so what happens is when they sell, so typical situation is you sell the property, you pay back the loan, which is what's going to happen here first.
Yep.
You pay your broker's fees who sold the deal. And then generally speaking, what happens is then you pay back your original principal or equity contribution, then you'll do splits. In this situation, we pay back the loan, we pay the fees, and then we just split. So there's no like, hey, pay back your original equity contribution, then we split. It's just split. And
Okay.
so that's how we do it is that would be a sell scenario.
Okay.
where we would do that. And then when that contribution comes over to our side of the hybrid debt fund one, then we would do a what's called a two-part waterfall. So it's an 80-20 split. So 80% to the investors,
Yep.
20% to the management, up to 13%, and then it's 50-50. So we're projecting
Okay.
11 to 13 net IRR for the investors. So that's scenario one. Scenario two is someone says, well, I want to keep the deal. I don't want to sell it. So that's fine. We just have certain thresholds that we need to hit on an IRR. So we'll
Mm,
have them make us an offer and say, look, this is what we think it's worth. We'll go out and do our own assessment. If we're all in the ballpark and in alignment, we'll concur with that. And then they could take us out, and it's the same thing, pay our loan off. We want that
okay.
pro rata share of that lift. And whether you pay us cash, whether you refinance us out with a loan, we don't care.
Okay.
Either way, we're still going to go for what we believe the value is. Gets a
Yep.
little murky because, there's divided interest there, right? They want the lower, we want higher. Oh, that's some back and forth that's going to go through
Okay.
possibly appraisals as well. So,
So yeah. So what's the an immediate question I have on that is what's let's call it permanent refinancing or the permanent
sure.
financing that they're taking you out with.
Yeah.
Is there a concern around y- the hybrid debt fund
Mhm.
receiving their portion of the equity that should be there as a part of the new financing? Do they look at that and they say, well, no, there's no equity. We're just going to give you,
Sure.
essentially, we're just going to give you a rate and term. We're not going to give you a cash out for
Yep.
single family verbiage, right?
It's a
What does that
great
look like?
it's a great question, and it's something that we thought through deeply when we were doing the
Yeah,
whole
that's good.
modeling up.
Yeah.
Because we and that's part of our, I guess, preemptive underwriting before we even issue terms on a deal is we're looking at
Mhm.
all these scenarios. So, okay, well, we fund this, then you take us out at that. What's your true all in what we would consider, a true loan to cost when all is said and done? Chances are you're probably north of 100%, meaning that that cost basis has gone higher. So we went through the exercise of circulating throughout all the different industries of CMBS, life companies, all these permanent
Hmm.
Fannie agency to say like, how are you going to look at this? Like,
Yep.
what's this going to look like when you get something where we need to be taken out and we're probably going to be north of the original basis? There's not going to really be quote unquote equity,
Correct.
cash equity into the deal.
Yeah.
I
Basis meaning how much you actually gave them. What shows up on the initial, ba-
yeah
you know,
yeah. What
balance
I
sheet.
Well, when I say basis, like let's say that they come in and they're like, "Hey, we're going to build this thing for 20 million bucks," and
Yeah.
that's their basis. And let's say we lent 18, just for the sake of discussion.
Yes. Okay.
When we go to take the loan out, we're going to be north of 20 million, right? Uh,
Yes.
and so now they have to get a loan that goes north of the original basis, which a lender's going, okay, well, there's really no cash equity into the deal. Well, it's
Correct.
not going
That's
to
okay.
work for a bank, okay, unless there's 5 years have gone by because they have this whole HVCRE issue, which we don't need to go into. But but for CMBS, not an
Hmm.
issue. Life companies, 50-50, right?
Okay.
Agency should be fine. So there's enough of the permanent lenders or bridge lenders to
Okay.
take our loan out that we don't really see it as a fundamental issue. Now, if we're underwriting up front, I'm like, and I see it as an issue, we're just going to deal with it up front. Be like, hey, how's this going to look? Because if you're going to try to keep this, like this is going to be tricky. And we'll
Yeah.
actually walk through the exercise up front, have the conversations, maybe even get some term sheets. So it's most of the groups say, look, you've added value, you've created value, you've increased the rents and done all these things. We're just taking value.
Okay.
So yeah, but it's a good question. It's one that we've wrestled around with
Okay.
and
So basically there are some lenders in specific spaces that will give you,
Mhm.
for lack of a better word, a cash out refinance to the guy who
100%.
wants to keep it. Okay.
Yeah. Yeah.
Cool. Yeah. I like to dumb things down for myself personally.
Oh, yeah.
Uh, you
Trust
know,
me.
so um okay, cool. So like what and and in my head as we were talking, it's like And let's clarify something. It sounds like, are y'all primarily lending on development deals, or are there other types of, you've just mentioned that a
Yeah.
couple of times. And as I'm trying
Yep.
to process
Yeah.
how you get your upside, development deals make the most sense, right?
Yep.
It might not make a lot of sense to just buy a cash flowing multifamily property. There might not be a lot of upside for you unless there was going to be a heavy lift somewhere.
Yep.
So what's the typical product that makes sense?
Uh, yes, both, meaning development and
Okay.
rehab. Those are kind of the two
Okay.
major areas. Our preference, especially right now, is rehab. Um, Reason being you can deploy dollars quicker and
Hmm.
you don't have as much of the longevity of construction. So we can do both, have no issues with both, set up for both. But yeah, it's all value creation. So there's got to be some reason why, hey, I'm buying this for X and I'm lifting it to Y. There's been enough situations that come in, it's like, not really going to add much value. It just doesn't make any sense for
Yeah.
us to take that additional risk. And so development is for sure. I would say we are open to all the asset types. We've had a tougher time with multifamily recently, just because for us,
A lot of
we
people
need.
have.
Yeah, it's just it's a tricky thing because with the interest rates, everybody's kind of scratching their head and going like, "What's that exit cap rate?" And
Hmm.
the margin our kind of lick test is spread between the yield on cost and the cap rate. So for example, when you basically say, okay, well, I'm going to build this project for, XYZ, I'm going to take the NOI and I'm going to divide it by that total cost. And then I'm going to say, well, what's your exit cap? Well, if I'm not
Hmm.
150 to 200 basis point spread between those two, then it's
Yeah.
hard to justify.
So in
Um,
in in non-lender speak, you want the
yeah,
cap rate to increase by 1.5 to 2 points.
correct.
You want to go from eight cap to a six cap, essentially.
100%.
Um,
Yeah,
okay. All
yeah.
right. Uh,
Works well
that
with
makes sense.
retail, works well with industrial. Storage seems to work, although storage takes longer to lease up, so that gets a little
Hmm.
tricky. But those are the ones that we've seen, generally speaking, that have a little bit more teeth to them.
Okay. Now, what is your conversation typically look like with the average general partner, the syndicator, the guy
Mhm.
who's doing the deal, who maybe
Sure.
he's raised money in the past, and so it's different. So what does that conversation typically look like?
Yeah.
How does it go? And what are the pros and cons for that GP?
Well, the first thing is everybody is like curious. What is this?
Yeah.
And it's good. So there's a lot of education, which is totally fine. And I would say they fall into one of two spectrums. I mean, if somebody has consistently been raising money
Hmm.
with family, friends, it's a lot of work. And so
Hmm.
they look at this as a way to simplify things. I think it's a way to keep more of the profit for them because they don't have to
Yep.
give as much up. I think it's a way
Because
for
those
them to.
numbers are almost flipped. What you said you were offering, right? So
Correct. Yeah.
y'all are taking about 35% typically,
Hmm. That's correct.
whereas typically that's about what a GP gets to keep, plus or
100,
minus, oftentimes minus. 20 to
100%.
40% probably is the range I would expect.
Yep.
Okay.
Exactly.
All right.
So most of these guys are in this situation. So they're like, okay, I'm going to keep more profit. I get to simplify things where I don't have to go get a bank or a bridge, then go get, raise all this equity. It's a lot of work.
Hmm.
And not to
Yep.
mention they have to figure out all the other entitlement stuff. So I think for them, it's a beacon of hope where they go, okay, this is great. I got one stop shop. I don't have to go through the brain damage. By the way, I have total control over decisions. I don't have
Yep.
somebody in my LP, and I get to keep the depreciation for tax purposes as well. So, the narrative works really well where things don't necessarily jive, we've seen, is when a GP comes in And they're like, "Well, I'm still gonna probably bring in some investors for this."
That
That
was going
can
to be
get
my question. So keep
Yeah,
going.
it can get murky, and the reason why is you think about it, and I just walked through how we get paid back. Well, now you've got this other group coming in and you're saying, "Well, we're gonna pay you a pref, then we're gonna give you splits with a waterfall," and they're like, "Well, who gets priority?" Well, it's us, and we're getting
Yeah.
priority, so
Because you're the
they're
lender.
we're the lender.
Yeah.
So so we're getting the first bite at the apple, and the rest of these people are getting kind of the leftovers of what does that look like? And
Yep.
so you're trying to mishmash these 2 worlds that might not work. We've seen it where they're like, "It's fine. We'll deal with that on our side." But that's where
Hmm.
things can get murky if someone doesn't have their own, could be their own cash or could just be their partners that are all like, "Hey, we've known each other forever. We can just put it in. It's fine." Um,
Okay.
so I think that's where things, or quite frankly, if we had one group out of Florida that they just have really good, they've just structured a really good deal with their
Hmm.
investors where they're getting really pretty de minimis splits, and it's real favorable to them. And
Okay.
so they just kind of go, yeah, it's probably not worth it. So I think those are the situations where it doesn't work. Or the other one is just if someone just has a lot of equity in there already. We had one in California that we looked at, we loved. It was an industrial rehab deal. Their basis was great. And I'm like, this is awesome. But I was on the phone.
Hmm.
I just said, look, I'd love to do your deal. I said 2 things. One, I just don't think you need us.
Yep.
Uh, you can go get a bridge loan, not give up equity. And the second thing is you do have other equity partners. It's going to get messy. So I think those situations where there's a lot of equity into it, it's probably tough. Um, so I'm always looking at things from everybody's perspective. Ours, obviously, because our number one is to our
Hmm.
investors and protecting them, but also for the developer, because I'm one myself. I'm like,
Yeah.
I don't know why you'd want to do this deal. So
Okay. So it sounds like almost both ends of the spectrum might not be the best fits. It's if they have so much equity in it, it might not make sense to bring you
correct.
guys in on the deal and just work with a
Yeah.
traditional lender.
Yep.
Then on the other end of the spectrum, if they don't have a dime to their name and they're having to raise that 15% approximately, so you go up to about 85% loan to cost,
Yeah. It's up to, look, we can go higher. I
varies.
mean, yeah, we can go 90, so
Okay. And so in that instance, they're having to bring people in. And now, is that a concern on your end specifically, or more of a, hey, this might not be a good experience for you and your other investors because they might get upset that we're the one in the pref position as opposed to them? Like, is there actually a legal concern for you, or you just know it's going to get messy and it's going to spill over onto you?
yeah, it's a good question. I don't know if there's necessarily a legal thing. It's probably just more of a communication and logistical thing
Yeah.
where we're just having, I mean, in a real sense, we are their partner, not in a
Yes.
legal sense, but so we're going to
In
kind
a
of act.
financial sense. Yeah.
Yeah. And so we're going to act a little bit like that, meaning like we're just going to be asking a lot of these questions and
Okay.
having a lot of dialogue, because they're going to have a lot of questions too. Is like, well, gosh, how's this going to work with the 1031? There's just a lot
Yeah.
of things that everybody needs to get their arms around to really get to full clarity. And that's going to be one of them is like, hey, have you had these conversations with your equity partner of how this is going to work?
Yep.
Because what we don't want to see is that you get yourself into a pickle. And if all of a sudden this doesn't, because we're taking risks too, like it may not perform like we all think, right?
Yeah.
That's life. And so we just want to make sure that they've had those conversations. Again, we're not pulling out the baby's bottle and milking them, but we want to know that there's a good line of communication going on,
Yeah.
so that we're all of a sudden down at the close and this lawsuit flares up because it's like, well, wait a minute, we we didn't even know about this,
Yeah.
which can happen, for sure if there's not good
Okay.
communication.
Okay, yeah, and you mentioned kind of, what happens if it doesn't go the way you hoped. One
Sure,
thing that I think would be, and you probably have to deal with this with your investors, is they hear 85% plus or minus loan to cost.
sure.
That's a really high loan ratio, right?
Yeah. Oh, yeah.
And so tell me a little bit about, why that, um, and I'm gonna make one assumption up front. It's
Sure.
primarily because you're doing development. It's not the final product. You're not buying a cash
No.
flowing property, right? But talk about the kind of the both sides of that, the pros and cons
Yeah.
of that loan to cost
Sure.
being 85%.
Yeah. And a few things I'll preempt with that too. When you look at, because we would classify ourselves, and I'm speaking specifically from the side of the coin of the investor investing in it, in this private credit commercial real estate. And I say that really specifically because you look at the private credit world, it's about 2.1 trillion. It's a big, big market. You've
Hmm.
got and it'll definitely surpass 3 trillion over the next 5 years. It's a big buzz. Everybody's kind of going after private credit right now, rightly so. But there's so many nuances to it where when you go, it could be credit cards, could be businesses. Ours
Yep.
takes a deed of trust, which we love, and has a personal guarantee. So I preempt that before I walk through your answer here is that
Yes,
we like
absolutely.
that elements of risk mitigation, because if I'm in a private credit with a business, a corporation, that business goes south and things don't work, there's nothing. I mean, you just don't
Yeah.
have anything to go after other than maybe a corporate guarantee or something that may be worthless at that
Yep.
point. So when we looked at this, you realize that there's more risk. You start going above 65, 70%, you start incrementally, because to me, it's kind of like, at what point do you really start getting this sort of bell curve of like, or this curve where you're going up, where you go like, okay, if I'm at 40, 50, 60, like, I don't think there's much incremental risk that changes. Get up
Yep.
to 65, 70. It's like, okay, that starts to go higher. Then you go above 75 or 80. It's like, okay, that's where you start probably
That's where you
topping
start to
out of,
think pretty hard.
yeah,
Yeah.
yeah. So I get it. And we've thought through that.
Yep.
For us, we look at it and say, look, we're going loan to cost. Okay. So 85 loan to cost. It's really
Correct.
important to understand the distinguishing factor between that and loan to value, which means
Yep.
once you're done with this project, and if you have any level of success leasing it up, which I think there's enough due diligence on the project that we'd say yes, then you're going to a different loan to value at that point. So now we switch from 85 to 75. Maybe
Yep.
it's 70. We've enhanced that equity component by the value creation, which by the happens of the market, the asset type, and the execution of the sponsor.
Yep.
We're picking good sponsors. That's what you're trying to do, is pick the right horse who really
Hmm.
know the craft, they know the market, they can execute, they have a team that can add value to that deal. So there certainly is 100% risks in that, where maybe they don't execute, or maybe the market turns, and now we're stuck.
Yep.
And now you go, okay, what do we do with that? And the way our response to that is, as long as we have gotten into a position where we feel like we've stress tested this to say what are likely scenarios outside of a tsunami that this is going to look like, and we feel like there's at least a reasonable way for us to get our principal out of this thing.
Hmm.
That's kind of our downside. Like, how do we at least get out of this thing with our principal?
Yep.
That's probably a win from a worst case scenario type of thing. But again, been through the block. You could have a major wild swing of something that, another COVID, or who knows what happens. So
Yeah.
those are outside of our control. You just
Yeah.
you can't
You could
operate your
have
business plan
shipping
on that.
just stop and, ships just sit in the Gulf of Mexico and not have any
Yeah,
materials to build, right? Like,
yeah, right. You're just
um,
there. Uh,
yeah. Okay. So, and then I think you didn't specifically say this, but you are talking about the difference between loan to cost and loan to value.
mhm.
In the single family, like hard money lending space, I know that a lot of times they'll kind of have this, we're going to give you the lesser of
Yep.
uh, loan to cost, or a bigger percentage of loan to value. So I assume that's something y'all are looking at. Hey, we're going to do
Yep.
85% of loan to cost, but
Not to
our
exceed 80.
expected, okay, not to
Yeah.
exceed
We won't
80%
ever
of the
exceed
final
80.
value.
Yeah.
Okay.
Like, we'll never do a deal where we look at it and go, "We're gonna be above 80% loan to value." And
Okay.
chances are we're probably more like 75.
Okay.
So, that's kind of our top end of loan to value where we would just say it's a couple of guardrails. It's the loan to
Yep.
value, your cash flow, meaning your coverage ratios. Those are
Yep.
kind of the other end of the spectrum because if we could be at the right loan to value and still not have good takeout numbers, it's like that doesn't
Yep.
work.
Okay.
So we look at all those things to say, well, if you can't sell and we have to go get refinanced, are there enough ratios on the debt service coverage ratio that we
Yeah.
feel like we can get taken out?
Okay. And so
Um,
if y'all are participating in about a third of the upside or a
mhm.
third of that final equity, that's going to be 7 to 8% on the back end.
Yep.
And then you're paying out, was it 5, 5.5 ish preferred?
Correct. Yep.
And that puts you at the 13 plus or minus percent is kind
Yeah.
of the goal. Does that, am
Yeah,
I remembering all these numbers correctly?
we're shooting for a net 11 to 13. That's kind of our
11 to
our
13.
aim. Yep, that's our
Okay.
goal.
Okay, cool. Well, you talking independently about different numbers all adds up to what you're saying your goal is. So it all makes sense.
Yeah.
Um,
Yep.
okay. And I know I had some other questions around that, but so that all makes sense. That helps an LP, understand
Mhm.
what y'all's approach is, right? So, oh, I know what it was. You were talking about private credit, and this is
Yep.
something that I've just really become very clear to me. And you're talking about private credit. Sometimes people will say, they're all very adjacent. We've got like debt funds, you've got income funds, you've
Mhm.
got private credit. Um, while income fund might sound the most straightforward and easy to understand, that
Sure.
doesn't mean it's secured by debt, right?
Nope.
Um, and so this is a space where, and I'll probably say it on this show, not our specific, but all the time, in the debt or private credit or income space, your return is probably significantly more pegged to your risk than a lot of other investments.
Correct.
Um,
Yeah.
and so I've seen something, like you said, credit cards. I've seen something where they were giving 30, 35% yearly returns is what they were talking about on this credit fund, and they were giving micro loans in third world countries.
Yep.
So, and it was like, wow, that is kind of terrifying. uh so
It is.
yes, and so like and that's something that I think in investors and limited partners, that's something that they should look at, right? Like, okay,
Yeah.
when they invest with you, they're looking at 11 to 13% probably, right?
Yeah.
Where
Correct.
they could go look at a guy like you are funding, maybe not the
Mhm.
same guy, right? Because you're their partner now,
Yeah,
but
for
someone
sure.
doing the same thing.
Mhm.
I don't know. I'm going to guess 18 to 21% IRR is
Yep.
probably, that's kind of the ballpark of what these guys typically aim for.
Yep.
Now, whether or not they're actually going to do it, it's totally different. But what they're going to
Sure.
be advertising is 18 to 21%. That's what all the multifamily people were doing
Mhm.
um, beforehand. Now that's a different story, right? So why should someone consider you at 11 to 13 over the guy who's running it, and they're going to get, and actually I'm gonna let you say it all, but I know part of it. I want you to explain it. So that's about a
Yeah.
5 to 10% swing.
Yeah. Yeah,
Why?
it's a great question that we've thought through, and quite frankly, investors should think through. I have the same dilemma myself. I invest in different projects and things outside of this. So, when you're approaching these things, it always starts with a goal, right?
Hmm.
Like, what am I trying to achieve? And where am I at in life? And how diversified am I? So when we look at it, we look at it as we are a complement or a portion of this spectrum of different investment vehicles that are out there.
Hmm.
I mean, I'm in private equity, I'm in business, right? So it's risk tolerance and goals, returns. What are you trying to achieve? So that's sort of that my step back, bigger picture of like, what are you trying to accomplish? Like, we're not
Yeah.
necessarily competing, if from my perspective, to that private equity person, although there is some level of that, kind of like the, hey, I'm going to Dominic's versus McDonald's, right? It's like, well, They're both restaurants, but it's just a totally different thing. So
Yeah,
from
two
my
different investor profiles most of the time. And then you
very
got
different.
some level of overlap,
Yeah, there's a little
smaller.
overlap. So
Yeah.
I think the reason why people go into ours and the reason we like it is because I'm an investor myself and I look at it and I go,
Mhm.
okay, if I go into the private equity deal, I'm now in the equity pool. A couple things happen that are just facts. I just took on a new level of risk of
Mhm.
legal, meaning that lawsuits happen. I'm now a part of that deal. I'm in it, and I'm going to get sucked into lawsuits that happen in that project. Uh, and as a lender, you're not. You're not
Mhm.
sucked into lawsuits, right? Like you just took that off the table. The second thing is that if things go south, as the common equity person, you're the first person to get wiped out. It's just
Yep.
it's a fact. It's gone.
Yep.
In our particular scenario, we are in a control position where we get to kind of say, look, we're either gonna play ball, and we always want to play ball, and that's the position we always want to start with. But at the end of the day, like we can pull the foreclosure card, right? If we need to take that
Yep.
asset back, we're going to take it back. And we have control over what happens if things go south. We are in the position of strength, I think, where
Mhm.
we are the one who lent the money, and we also don't take on that additional exposure. The benefit of it is you get this ongoing income, which you may in a private equity deal, but you also get that upside pop without
Yep.
taking that additional risk,
Yep.
because everything comes back to risk adjusted returns. To your point, hey, I'm making 30%, which I've heard the same thing. And I'm like, well, what risk did you have to take to get 30%? Because anybody who knows investing, you just don't go make
Yeah.
30% with a low risk.
Yeah,
Uh,
do
you
500 loans so people can buy a cell phone, and
yeah,
hopefully that person's bettering their life and starting a business, but
yeah.
do I want that risk on me?
Correct. So it's all you're always asking as an investor, what is the risk? What is the return? What are my
Yep.
timelines? So I think from our perspective, we look at it and say, look, you've got this great opportunity to lower your risk, downside risk with all of this collateral, personal guarantees, foreclosure
Mhm.
rights, and then you get to increase your likelihood of upside along with your income. It just seemed that's why we call it hybrid. It's like you get this best of both worlds.
Yep.
And we don't have a lot of competition in our space at all. And that was on purpose.
Yep. You're the only
So,
guy that I personally know doing this, right?
yeah,
So
yeah.
that's why I
So,
wanted you on.
yeah, it's very nichey, it's very unique, but it also provides it's very thoughtful and it's been
Mhm.
around.
Mhm.
This isn't, again, this isn't some sort of made up, concept that I woke up at 2 a.m. went, oh, that's cool. It just is. I've been around the block a long time. You know how to minimize risk and get returns. So yeah, we're just super excited about it. And we think it's a great opportunity for investors to, get those great risk adjusted returns. And quite
Yeah.
frankly, right now, we have a little bit of the corner on the market, meaning this is a great time because everybody's driving through fog right now. They're just kind of going like, can't get equity. We're trying to figure out how to do this deal. So there's a lot of good operators with good deals that in a
Yep.
normal crazy market, well, I shouldn't say normal, crazy market we were in, people were just getting money thrown at them right and left.
Yep. Yeah, that's something if for anyone who's newer to this and you've entered the market or the space in the last 2 years, right? Um, you know, what you are seeing the results of is a really in particular the multifamily space, right?
Yeah.
And this is a problem that David you're solving is you had all these syndicators and general partners and maybe funds coming in and raising money and getting traditional bank financing as much as they could on variable uh, interest only loans for 3 to 5 years, and then the market just fundamentally shifted, right?
Yep.
Something that
Correct.
they thought they were going to get in, a decrease in the cap rate, meaning an increase in value, uh, or they were going to increase their cash flow. So the same
Mhm.
cap rate was going to increase the value. That didn't happen. They went maybe negative on their cash flow or break
Yep.
even. And those values plummeted because of how commercial properties valued. And
Yep.
so The first person that lost all their money on this deal that was supposed to be a 20% return with a syndicator who'd had a great track record the prior 10 years, a lot of value got dropped. Well, if the property only lost 20% of its value, that 20% of its value might have been 100% of the equity, right?
Exactly.
And so the lender, when that property gets fire sold, or when it changes hand, or when it gets taken back, or when the syndicator sells it at a 20% loss because he can't do anything else other than get a foreclosure, the lender's made whole first. Then well, I guess maybe you've got fees. The fees and sales costs kind of go hand in hand with paying back the
Yeah,
lender.
it
Let's
does.
just say those are lumped together as the first thing that gets paid. And after that, if there's anything left, then that's going to get pro rata shared back with any of the common equity interest, right?
Yep.
Um, so they're like, I know some syndicators who are in that, not quite, like I have some pretty good friends who are not quite in that boat, but they're struggling, right? They are staying afloat and holding on to their properties so that they don't sell at that 20% discount,
Mm-hmm.
which is 100% equity loss.
Yep.
I know stories of it happening. I don't know if you heard, I mean, there was a really big syndicator. He had a lot of properties in the
Yep.
Houston area. It was like the largest commercial foreclosure. And it was huge. He had properties all over Houston. He'd been raising money to buy stuff, refinancing, paying, and it wasn't it wasn't a scam initially, but I think that he did essentially mix and mingle money in ways he shouldn't have
Yeah.
by the end of it. And
Yeah.
everything was a total loss.
Mm.
Um, and so that's what David's talking about. Yes, maybe you're not getting 18% IRR, but you are significantly mitigating your risk, right? So, all
Yeah.
right, David, if you have a few more minutes, I want to touch on what are some other investments that you have. You said you're in businesses. Like I
Yeah.
have some business investments.
Mm-hmm.
What's kind of your background and your experience in the passive investing? And because I want to be able to share
Yeah.
some of your experience with the listeners as well.
Yeah. Look, I've invested in medical office. I've invested in apartments, both principally and passively. We are developing an RV park right now.
Okay,
And up in Phoenix, outside of Phoenix, there's a little town called Black Canyon City that we're doing a 138 unit RV park,
is
luxury
that going to
RV
be
park.
like one of the glamping sites, or
Kind
is that
of.
going to be more of a traditional like?
It's traditional, what I call transient RV, luxury RV. So you come in for 4 or 5 days, come out,
Okay,
got pickleball
high end like
courts.
RV.
Yeah, yeah.
Okay,
It's high. It's luxury RV parking. Well, I think
okay,
we have 15 modular cabins.
okay.
So yeah, and I've invested in all sorts of things, businesses. So
Yep.
you know, I've deeds of trust. So I
Mm-hmm.
think it's really, for me, whenever I've invested, it's always me thinking through the downside. I think it's just the
Yep.
way my mind works. I'm like, okay, what's worst case scenario? If I have to foreclose or if this happens, what's going to happen? And so it's just taking the time to think through likely scenarios. And quite frankly, if I don't really understand, if I can't get my arms around something, I just don't invest in it. If it's just too
Yep.
complicated, I'm like, if I can't get my arms around it, I just don't do it. And there's a little bit of the Warren Buffett. It's like, man, if it's not too simple for me to get my arms around, I'm kind of like out. So I think that's my approach to investing is I look at the downside, I try to figure out worst case scenario, and then I just look at my overall portfolio and I go, look, if I'm going to invest in this, what happens if I lose all of it? And you
Mm-hmm.
just have to ask that question. If I lose all this money, am I going to just be devastated or am I going to be like, that sucks? I'm not happy
Yep.
about it, but life goes on. I've had investors come in and I've said that very thing to them. If you lose all your money on this, how are you going to feel? What's going to happen?
Yep.
How bad do you need this? Because if the answer is it's devastating or it's going to really rock your, I said, don't do it.
Yep.
I said, I'm confident with what we're going to do, and I don't think that's going to happen. But if that's what the money you're putting in, don't do it. And that's usually my approach personally. I just invested in a CLO deal, and it's doing well, but I
What's a
know
CLO deal?
CLOs, they can well, it's a collateralized loan obligation, so it's like a
Okay.
pool of loans that you can take different tranches of it. It's like
Okay.
CMBS, they'll do these different levels of tranches where it's like you could be the first tranche and it's the lowest risk, you get lower return, or you could be at the high end of the CLO tranche where they split them up and carve them out
Okay.
into buckets of loans, and they take leverage out. So it's a riskier proposition, but it was this very small sliver of my portfolio. So I'm like, it's okay. If I lose it, it
Yeah.
sucks, but I'm not going to lose sleep. So
Yeah.
yeah,
Yeah.
that's my approach.
Yeah. And so just for the listeners to know, like we met at the passive investor event. And so
Mhm.
I'm going to plug that again.
Yeah, for
That's going to
sure.
be this October. It's great. And one of the things that David's talking about is looking at his portfolio and understanding it, right? That's going to be one of the first things that you need to do. If you're not tracking it, then you can't really improve it or not efficiently. You might stumble into it growing, but probably not nearly as well as it could be. And so one of the things that I've loved about Keith and the passive investor of it is
Mhm.
really helping you, the passive investor, the limited partner, that highly paid attorney, doctor, business owner, who wants to maybe de-risk a little bit out of the stock market and some
Mhm.
alternatives, um, helping you understand what type of investor you should be.
Yeah.
Right? I'm young. I have a lot of earning years in front of me. Technically, I should be a fairly high risk investor.
Yeah.
Um, I also like debt. I like security. So, but I mean, to David's point, I'm talking about high risk. Like me and my wife have some money in what is essentially a pharmaceutical product that
Well,
is either going to be $0 or it's going to be a 10 or 100x return.
yep.
Um, but that's a very small percentage of our net worth, right?
Yep.
Uh, then I invested in a business as well, and that thankfully that one's going pretty well. Um, I invested in a manufacturing business, but
Mhm.
then I have apartments and some other stuff. So I'm in debt. Um, but what would you say? So here's something I wanted to get to as well. So
Yeah.
one, understanding like what type of investor you are, that's
Mhm.
important.
Sure.
But then when someone's coming to you, you are raising money for a fund, you have a product you're offering, and you also invest in other things. Is that a and I realize like you're doing it, so I'm kind of putting you on the spot. But
Yeah.
what kind of questions should a limited partner ask in a
Oh, yeah.
scenario like this, where it's like, well, if you're offering this product, why isn't every single dime you own in this product?
Sure. Yeah.
And I'm not saying it should be, but how do you talk with people about? I'm sure you've got some level of question around that.
Yeah, it's a great question, and we are very transparent. So it's like we love people asking questions, and we want
Yep.
them to be fully informed. So just like I would on the other side of the coin. Couple things. One is it wouldn't be prudent for me as an investor to throw everything in one thing.
Yeah, you're absolutely right.
uh,
That's top level.
yeah, so I would say that's foolish, right? Just
Yep.
to do that, especially as you age, right? Uh, you know, so that's the first thing. I do have skin in the game. We've got money
Okay.
into this deal. So we believe in it. We're behind it. We're invested in it. We're all in,
Good.
right? I mean, it's
Good.
it's all we do. Um, the questions they should ask is the ones we've been talking about on the show, right? Like, how do you make
Mhm.
decisions and why? How are you choosing a loan, right? Versus not? Like, what's your process that you go through? And we're very disciplined and diligent. That's the one thing about us where anybody who works here, they know we're just very disciplined. We're very diligent. We've said no to most of the deals.
Yep.
Just and it usually, again, we have very strict criteria on the sponsor. If it doesn't fit, we're out. We are very strict on the location and
Hmm.
their projections and all those assumptions that go into it because everything's always comes back to assumptions.
Yep.
Uh, so I think someone should be asking questions about like, how are you making decisions on this?
Hmm.
And then obviously the question you ask is like, what you're investing in it and like, who's the team, right? Like
Yep.
who's involved in this and like how good are they and how much they really know, what they're doing at the end of the day. And then obviously when they're reviewing the PPM, they want to know about like fees, Is
Hmm.
this excessive? Is it too much, too little? How do how whipsawed could my investment get? My head of US distribution we just hired, I had him go through the PPM. I said, I want you to scrutinize it. Like, what questions, tough questions do you have? And so he's got about
Hmm.
a page full of stuff I answered this morning. And, I was answering his questions back about things like, he's like, well, wait a minute. Like, you have the ability to change the pref at any given time during the thing. He's like, that seems a little
Hmm.
risky. And I'm like, well, I'll tell you why. I said, I don't control what the market says the interest rates are. If all of a sudden interest rates start dropping and I have to copacetically be around that rate, I can't pay
Hmm.
the same preferred rate to the investor.
Yep.
Otherwise, at some point, I'm upside down.
Yep.
So I think it's reviewing the PPM. It's making sure that fees are reasonable. It's understanding the investment vehicle, like we've talked about today, and really getting
Hmm.
your arms around that. And then it's the sponsors. Like, do you
Yep.
trust that this person that you're working with has a team that knows how to execute and they functionally can execute or not? That's at the end of the day what people are trying to know. And then everything is relative. It's like you should put a portion of your investment in this and something else. Um, so those are the kinds of questions I think people should
Okay.
generally be asking us, and we're happy to oblige. And we love meeting everybody that's going to invest.
Yeah.
Right? It's a two-way
Okay.
street too.
Yeah, yeah. All right. Well, as we near wrapping up, man, give me a couple of red flags that investors should be looking for. Um,
Yeah,
maybe first in the debt space,
yeah,
you adjacent to you, but then in general across this alternative space. Like,
yeah.
give me a couple of these things that are just like, hey guys, this is what I've seen. You got to look out for this.
Yeah, a couple things I would say in the debt space as a whole. You really need to know what kind of debt they're deploying. I mean, there's hard money lenders, which is great. You do straight first deed of trust; those are great. Versus a mezzanine lender, right? That's
Mm,
all the way up in the stack, and there really is no real estate collateral. There's kind of a business collateral. So you really need to
hmm.
know, what are you securing and what are you not? What position are you in when you're lending the money? Is it against the real estate? Is it against the business? Is it against chattel? Is it against equipment? So you really need to know that,
Okay.
and ask those specific questions in the debt world. In my position, and to your point, loan to value, right? We're a little higher loan to value. Got to understand that. Otherwise, you could get wiped out. In general, I would say, if you do a good job of asking questions and you've prepared good questions, if you get the sense that the person is vague or you can't get clear answers out of them, even if they don't have the answer, then sometimes I'm like, it's a good question. I don't know, but I'll get back to you, and they
Yep.
do. Um,
Yep.
but if somebody's evasive or vague, or just, you just get the sense like, man, I can't get a clear answer. Like, just
Hmm.
run the other direction.
Yep.
I've seen that in my life where I'm just like, why, why can't I get a clear answer? And
Yeah. I've asked this three different
yeah,
ways.
correct.
Yeah.
That
Yeah.
is a red flag for a couple of reasons. One, someone legitimately just may be being evasive.
Yeah.
Or they may just not know what they're talking about, but they try to look like they are. That's even worse. So either way, that to me is big red flag. And I would say, as an
Yep.
investor, like, your job is to do your own due diligence. So
Yep.
spend the time to think through. You can even go on ChatGPT and say, like, what questions should I be asking? That's great. Then ask the questions.
Yeah.
And that's my advice to investors: is be informed. Don't blame anybody else. Make your own decisions and come to your own conclusions.
Yeah. Yeah. Okay. Well, cool, man. Tell us about your specific offering now, and then what's
Yeah.
the best way to get a hold of you for someone who is like, hey, that actually sounds like a really good fit for
Yeah.
my portfolio.
Yeah. Minimum is $100,000 investment. It's a Reg D offering, which means you need to be an accredited investor. It's a, sort of, you know, so I could say that's the offering. Obviously, what we do, we take a capital commitment and we do a drawdown. which means that
Okay.
you're going to sign off and commit to it, and then we're going to do a drawdown based on the schedule.
Hmm.
And so the way they can invest with us, they can go to hybriddebtfund.com, get our
Okay.
information there. You can reach out to me personally, Dave.Kotter, Kotter at hybriddebtfund.com or 602-367-8795. I'm happy to talk to
Yep.
anybody through a deal.
Awesome. Well, man, we'll get all that in the show notes. I assume you're probably on LinkedIn as well.
Yes,
Uh,
correct.
so we'll make sure that we've got all your info in there, man. But I really appreciate you being here today. And this is a really interesting one. I like this one because you do get that security and you do get a little
Mhm.
bit of upside. And it's a way to kind of juice your returns a little bit without increasing your risk significantly.
Yeah. Thanks for having me on. This has been a lot of fun.
Absolutely, man. So, what I love about Dave's approach is that you don't really have to decide between super safe and high growth. Dave has a great blend of those two options. Now, if that's something you're interested in, reach out to Dave, let him know you heard him on the show. And if you want more content like this, hit that subscribe button. And before you go, if you need help doing due diligence, just like Dave mentioned, using ChatGPT or something similar, go download my free guide in the description below, how to use ChatGPT for due diligence, and we'll see you on the next show.